Thank you very much. As many of you know, or may know, I'm a director of Durban Deep, or DRD Gold as it's now called. And Mark Wellesley Wood, who's the CEO, asked if I could read a brief statement from him. Let me from the outset send my sincerest apologies for not being able to join you at this historic event. However, those of you who have followed the fortunes of the business will be all too aware of the tough times that we as a company have been going through over the last several months, hence my need to stay focused on the operations. But although we have been busy, we continue to follow the fortunes of GATA and its members and are pleased by the continued support that GATA is receiving. We hope to see many of you at the New Orleans Investment Conference at the end of October. From myself, the company, I wish you a successful conference and all the best. We will be following your progress. With fondest regards and our continued support for GATA, Mark Wellesley Wood and the DRD Gold team. It's both an honor and a pleasure to be here today and have this opportunity to talk about the future of gold. But before I get to the future of gold, I want to provide a little bit of background information about what some people call the barbarous relic. This term is attributed to Keynes, and if you actually go back and read Keynes's writing, he did create the term. He used it in his treatise of money, but he wasn't talking about gold. He was talking about the gold standard. He called the gold standard a barbarous relic, basically because he wanted to usher in a period of managed money without the discipline tied by gold. But the anti-gold propagandists have used this term, barbarous relic, very effectively to disparage and denigrate gold. Now, there is a barbarous relic, and I will identify that in a minute. But before I get to that, I want to explain why gold is not a barbarous relic. And I'd like to do that with a couple of charts that I brought with me today. This one is the price of gold. It goes back to 1945, and in order to make a comparison that I'll be doing here, I've used a base 100. In other words, in 1945, I said gold was 100 units per barrel. And as you can see today, the price has risen to almost 6,000. This is actually the end of July, so maybe it's over 6,000 today, given what John was saying about the price of gold in the market. Now, this is the price of gold over that same period of time, base 100, in terms of gold grams, 1 gram of gold. Now, using this chart, I'm going to make the point that gold is not barbarous because it effectively communicates value, which is the essential role and essential function of money. And it's not a relic because it's effective in communicating value as effectively today as it was 10 years ago, 20 years ago, or 30 years ago. It's a form of measurement that has been given to us in order to participate and work with one another in society as we go about exchanging goods and services for money. And it's not just against gold that this relationship of being able to measure value works effectively. In 1914, the British pound had essentially the same purchasing power that it did 200 years earlier when Sir Isaac Newton invented essentially the gold standard. It wasn't just the British Navy that created the empire. It was the British pound on gold and essentially the rule of law and the willingness to follow the voluntary system under the classical gold standard. In addition to measuring tangible assets with gold, you can also measure financial assets with gold. And this is a chart of the Dow Jones Industrial Average going back to 1913 with the creation of the Federal Reserve. And you can see at moments in time, the Dow is expensive and the Dow is inexpensive. And let me just put 3 little lines on there. That first peak is 1929. That second peak is the late 1960s. And the third peak is, well, where we are today. And what this chart is saying to me, again, gold is performing the function that it's always performed. It's giving us a tool, a means to evaluate what is going on in our free market economy, or what we like to call our free market economy, or what some people call the market process. Now, if gold is not the barbarous relic, and not even the gold standard is really the barbarous relic, what is the barbarous relic? Central banking. What I'd like to do today to begin is I'm going to run through 10 reasons why central banks are barbarous, and then I'm going to also explain why it's a relic. And as I explain why it's a relic, I'm also going to be talking about the future of gold. Now, You might say, well, why 10 reasons? And very simply, I had to stop somewhere. There are literally dozens and dozens of reasons why central banks are barbarous. We've heard many of those reasons already today. Some of the reasons that I'm going to explain, to identify this morning, come from an excellent newsletter that Franklin Sanders just wrote, The Money Changer. Catherine referred to him earlier today. That was a very, very good analysis of central banking. But anyway, let me get into it. First reason, money is a product of the free market. It's a fundamental building block of our society because it allows people to interact with one another in the market process. Money existed long before governments began managing it, and tragically, instead of being a neutral and unhindered tool in commerce, fair to one and all, money has, through central banks, now become a matter of force and decree, which is disruptive to the market process and therefore harmful to society. Number two, prior to the creation of the Bank of England in 1694, every exchange in this interchange of activity we call the market process traded value for value. In other words, gold traded for land, silver traded for food, et cetera, assets traded for assets. The Bank of England changed this process by creating money substitutes we call banknotes. They are not a tangible asset like gold or silver. They are just money substitutes and not money itself. Money substitutes are a liability of the bank issuing that paper currency, which brings with it all sorts of payment risk that one does not have when using tangible assets as currency. Third reason central banks are barbarous, they act in secrecy, and consequently, they are not accountable. They consider themselves and act as if they are above the law. What's more, this secrecy favors the insiders, and it is this fundamental principle upon which the gold cartel has been constructed. Number four, central banks have freed governments from the need of having to ask their citizens, through their elected representatives, for more taxes. Central banks can take government debt and create money out of thin air for governments to spend on their latest whim. What's worse, through inflation, central banks enable governments to steal from their citizens. Number five, there are several tools in the central bank's arsenal, and one of them is disinformation, which they regularly practice. For example, central banks have come to make us believe that inflation is rising prices, but as we all know, wet streets do not cause rain. By changing the definition of inflation to one of rising prices rather than what it really is, monetary debasement engineered by the central banks themselves, the true culprit, which is the central banks, is masked and leads to the next point. Not only are central banks guilty of disinformation, deception is one of their most frequently used tools. The history of banking is replete with examples that are not just a lack of disclosure, but rather outright deception. To give just but one example, look today how they count for gold loans. They carry gold in the vault and gold out on loan as one line item. In effect, they are saying they are above generally accepted accounting principles and that they can as a result report cash and accounts receivables as one and the same thing. Accounting like that would make even the people at Enron blush. And it also highlights the seventh point. Central banks have, in effect, turned the market into a command economy. The power to create money out of thin air brings with it the much greater power to control a nation's economy and therefore the economic destiny of millions. Central bankers today are no different than the former Soviet Union Politburo members who pulled strings and pushed buttons to try making the economy, which means each and every one of us who participate in the economy, bend to their beck and call. But it is not only the economic destiny of millions that is determined by central banks, which brings us to number 8. Central banks and their comrades in government know that this command economy forces them to walk a fine line between prosperity and economic collapse, given the inherent fragility of this credit-based economy which they operate. To try reducing this ever-growing fragility in a vain attempt to make it easier for central banks to effectively and totally control the command economy, governments take away people's freedom to act. Central banks usher in controls, like the reporting now required in the Patriot Act, and policies, ever hear the too big to fail doctrine, to perpetuate their stranglehold on power, regardless whether they're doing a good or bad job, and usually it's bad, in commanding the economy. Number 9. The command economy that central banks rely upon encourages the growth of debt rather than savings. Now, I could spend hours on this one topic alone, but let me just say that the mountain of debt that exists in the U.S. today and the excessive consumption that continues to grow that mountain is directly the result of central banks and their need for more debt. Newsletter Richard Russell explains it very simply in just 3 words: inflate or die. That's why you have people like Ben Bernanke, who is reportedly being considered as a possible replacement for Alan Greenspan, recently saying that he will drop $100 bills from helicopters if necessary to inflate the economy. And lastly, what central banks do domestically, they also do to the international monetary system. The inherent fragility and the huge structural imbalances that exist today because of central banks is not just a domestic problem, but one that has global implications. Now, as I was putting this presentation together, truth be told, I couldn't stick to just 10. I had to add number 11. So we don't have a round number, but this is perhaps the most barbarous of all for everybody here in this room. Central banks, because our central banks are barbarous because they manage the gold price. And they're barbarous because of the impact that their management of the gold price, keeping it at an artificially low level, has done to the thousands of shareholders, thousands of employees, and indeed everybody in the gold industry worldwide who isn't earning the wealth that they should be earning if the gold price wasn't being managed. Well, I think I've pretty well nailed it down in terms of why central banks are barbarous. I'd now like to fulfill the other half of the bargain, why they're a relic. And in order to do this, I first want to differentiate between money and currency. We use these 2 words interchangeably today, but in fact they're different things. Up until the creation of the Bank of England in 1694, money and currency were indeed one and the same. It was a tangible asset, usually gold and silver, but other forms of tangible assets like tobacco in Virginia during colonial days, et cetera, circulated as currency hand to hand. But if you look at the history of money, money does one thing. It's a mental tool that enables us to communicate value. So throughout history, money has never changed. It does the same thing today it did thousands of years ago. What changes is currency. So the history of money is really the evolution of currency in its different forms. And what the Bank of England did is they had a great idea, the promoters of the Bank of England. They said that gold is too valuable, silver is too valuable, too cumbersome, whatever. Let's leave it in the vault. Let's create this piece of paper we call a banknote and let this money substitute circulate instead of money itself. It was a brilliant technological innovation. Bank of England was created in 1694. The first banking crisis occurred in 1696 because they had issued too much paper relative to the amount of gold that they were holding in reserve. Now, this was a time when the co-regents William and Mary were on the throne in the UK, and they were fighting wars against France, the Jacobite rebellion. It was just a few years after the Glorious Revolution, and there was no creditworthiness in the crown. And the king needed money. So what he did is he asked the most brilliant person of his day to solve this problem, and he chose Sir Isaac Newton. And he said to Newton, look, we figured this out, create something that works, and let's put it into place. So what essentially happened is Isaac Newton analyzed the problem. He recognized that what the Bank of England was bringing to the table was an important technological innovation in terms of the form of currency, and created what we now know as the classical gold standard. And it worked very, very well for 200 years. The problem with it is that the classical gold standard was a voluntary system that governments would agree to voluntarily. By the late 19th century, they understood that they could twig the system to their own advantage, to the detriment of their citizens. And last century was basically one of how they moved away from the classical gold standard to what we have today in terms of currency, or what passes for currency. But the fundamental point is that what we consider today and often call money is currency, and it's a money substitute. Money has to be a tangible asset. And I learned this point many years ago, probably 20 or so years ago, when I read some of Antal's writings, he uses the term extinguish. When you use an asset in exchange for another asset, in other words, if I use gold to buy a good or service from some supplier, I'm extinguishing the exchange at the moment that those assets exchange with one another. But if I use a money substitute, the exchange is only completely extinguished when I take that money substitute and pass it on to someone else for a good or service. And that brings in a whole lot of costs and risks associated with it. Now, I want to get into an explanation to sort of set the groundwork as to where I'm going for the future of gold. And I want to use the invention of the automobile as an example so I can relate it to where money is today. If you look at those pictures of the first quote-unquote car, it looked more like a carriage without a horse than it did what we would call a car. Now, that's an important observation to make. It looked like that because those inventors thought transportation was like that. Up until that moment in time, transportation was basically carriages pulled by a horse, and there were constraints. Those early inventors didn't realize how profound their invention was and that they were no longer constrained with speed, comfort, weight, and those issues. And over a period of time, a period of years, what emerged from some of those workshops of those early inventors is what we could really call a car. It started to have fenders, pneumatic tires, some speed to it, comfort, roofs, gloss, etc. It was primitive, but it was a car. Now, flash forward today to where we are with the internet. Just like those early inventors were looking backwards as to what transportation was, making plastic circulate as currency on the internet is like those early inventors of the car. They're looking backward as to what plastic is or what currency is today and thinking, well, how can we make this work in the invention, rather than understand what the profound nature of the invention is itself, and use the profound nature of the invention to create a whole new level of currency which has never before been possible. Now, let me put this into perspective through another example. If we were here in 1977, and I said to you, in 10 years' time, the PC, which wasn't even called the PC in 1977, but if we said in 10 years' time the PC was going to turn corporate IT departments on its head, it would have been a very outrageous statement. But in fact, that's exactly what happened. The PC moved from being a hobby to a corporate tool in 10 years. And by 1987, corporate IT departments were fundamentally changed. They were still there, of course, in 1987, and they're still here today. But the way they did business was changed fundamentally by the technology that came to the table. And what I say to you here and today is that in 10 years' time, bank payment systems are going to be as fundamentally changed in the next 10 years as the PC changed corporate IT departments, for one reason: technology. The way we operate today is a 300-year-old system of money substitutes. It's costly, it's expensive, it doesn't work for the online demands of global commerce, because when you're circulating liabilities of a bank as currency, you are basically dealing with payment risk. Plus, you also have other elements. Once a day at 3 o'clock, the banks bring their balance sheet back into balance. Because of that, you don't know until 3 o'clock whether the payment you're going to be getting from that other bank is good or not. So what we need to do is think back, well, what is money, and how can we use this technology to our advantage? And essentially what I see the future for gold being is, once again, not only is gold money, like it was in that chart of communicating value on oil prices and the stock market, but using it once again as currency in day-to-day transactions. It may not move hand to hand like gold coins did, because that was the currency of the 19th century, but it may move technologically, digitally, through our cell phones while the gold stays in the vault, but there's no banknote created, no money substitute. You own the gold at all times, which is essentially what we've done in gold money. Not too many years from now, when the US dollar collapses, I think people will look back and ask themselves, how is it possible a barbarous relic like central banks could have hoodwinked so many people into thinking that central banks were a good thing? Well, one could argue that maybe for 200 years under the classical gold standard, they were indeed a good thing, but that's another matter. Clearly, they haven't become a good thing today. But people, I think, see them as a good thing because central banks have created the illusions of prosperity. Because people think they are well off, they have no reason to question basic tenets that they were led to believe. So for this reason, people are easily coddled into believing that gold is a barbarous relic, when in fact it's not, and that central banks are doing a good job when they're really not. And more to the point, that their financial future is secure, but nothing could be further from the truth because of all of the problems associated with the current monetary system and the structural imbalances that have arisen. It is what some on Wall Street call the bubble mentality. And while it may be true that the condition is a state of mind, it's also true that it arises without any thinking going into it. Thus, the future of gold, I think, depends enabling it to circulate once again as currency in parallel to and competing with government-controlled national currencies. The future of gold depends on the opportunity for gold to do what it has always done throughout history, namely to provide a neutral tool that people can use voluntarily without force or coercion as currency as we go about our business each day, participating in our market economy to fulfill our needs and wants. So in my vision, the future of gold is what my fellow shareholder partners and I have created in Gold Money. It's the opportunity to use gold as currency. And let me just give you a couple quick examples of how this is evolving. You probably know about my book, The Coming Collapse of the Dollar. As a consequence of my very bearish view on the dollar, but the need to hold some dollar balances, what I've basically chosen to do is hold next to nothing in terms of dollars and keep my balances in gold. When I then need some dollars to write a check or go get cash out of the ATM, I go to Gold Money, I get, say how many dollars I need, and the next day those amount of dollars appear in my banking account at spot and with no fee. We're tied into what's called ACH, the Automated Clearinghouse, in the United States, also in Canada, and we've just been approved for the bank clearing system in the UK. So we'll have the same type of flexibility of moving back and forth between gold and national currencies without having to hold national currencies. You'll still have the flexibility to use them, but keep your liquidity in gold. A second example, one of our shareholders is IAMGOLD, the Toronto Stock Exchange listed company. And we're working with them on a mechanism that they will enable to pay a gold dividend using Gold Money. A third example is another shareholder is DRD. And we're working with them on a system that right now we only have one vault, but the vision in Gold Money is we'll have many vaults around the world. And we intend to open our second vault later this year in Australia with Brinks. And what DRD will do is it produces some gold in Papua New Guinea. The bars come out of AGR Matthey in Western Australia, and instead of being sold to a bullion bank, they're going to be popped into the Brinks vault and spent by DRD as it meets its normal currency needs. So what we're doing is we're turning gold into currency, and I think that is really the vision for the future. Now I'd like to end with 3 charts and 3 quotes. I want to offer these as food for thought. 2 of them are by Ludwig von Mises, who I think is the greatest economy of the 20th century. There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion or later as a final and total catastrophe of the currency system involved. And this is a chart of the current account deficit of the US dollar. I could have put on there a chart of the purchasing power of the dollar, any number of other measures of the dollar. There is a crisis coming, and it's going to be the total collapse. It was mentioned earlier about in the U.S. Constitution, there's the requirement for being gold and silver coin. That was there purposefully. The framers of the Constitution had lived through the monetary turmoil of the Revolutionary War, and they didn't want their legacy to have to learn the problems that they learned previously. And that system worked relatively well for 175 years. We abandoned the wisdom of the framers of the Constitution 30 years ago, and we're going to suffer the consequences, which is the total collapse of the currency, just like they suffered the total collapse of the continental currency, the currency of their day. Second quote is in a letter from Washington to James Madison. Thomas Jefferson had similar sentiments. No generation has a right to contract debts greater than can be paid off during the course of its own existence. And this is the total debt versus national income of the United States. For you cash flow guys out there or bankers out there, this is the kind of thing that gives bankers nightmare. Income is going at one level. debt is going at another level. We're reaching a stage that you cannot generate enough cash to service the debt obligations. And if interest rates go back up, as I think is inevitable if they're going to save the dollar, that it's going to even worsen the cash flow problems further. And the third quote, again, going back to Mises, it is impossible to grasp the meaning of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against despotic inroads on the parts of government. Ideologically, it belongs in the same class with political constitutions and bills of right. In the chart, the top line shows the decline in the private sector in the U.S. economy. The rising line at the bottom shows the growing government sector in the U.S. economy. It's no wonder that the U.S. is in the situation that it is today because of abandoning the basic principles of sound money. And the future of gold is basically reestablishing those sound money principles. Ladies and gentlemen, thank you very much.